Hello, traders. FX Speculator here. Today is Wednesday and it is September 17th. So, how is everybody doing today? Hopefully, everybody's doing fairly good. Markets potentially going to make some pretty decent moves today. I think we definitely have some potential for some nice moves. So the reason why we're all here a little bit later today is because of the federal funds interest rate news that's coming out for the U.S. This afternoon we had the Canadian interest rate news also, which is a pretty decent news event. But honestly, it didn't really have that big of an effect on the market. The CAD pairs kind of went up and down, didn't really do a whole heck of a lot. But the U.S. interest rate is always going to be the big mover, over all the other interest rates. Definitely, they are planning on lowering 25 basis points, which apparently this is going to be the first time. This should be the first time that they've lowered rates this year, I believe. I think the last time they lowered rates was last year. They most likely are just going to do 25 basis points, but if they end up doing, 50 basis points or something like that, it potentially could be a big market mover. Earlier this week, Trump was saying that 25 basis points was not enough, that they had to do more than that. I don't really, Trump obviously doesn't really have much of a say in it, but most likely it'll be 25 points. If they do decide to do 50 points, then the market is definitely probably going to go wild over it because that will be a surprise to the market. The whole thing with these big news events is when they forecast, a 25-point drop, if they do a 25-point drop, then that's not really a surprise to anybody. When there is a surprise, that's when the market potentially can go really wild. So if they do like a 50 points or something like that, that's when you have the potential for a big move in the market. Now the news is in about 27 minutes. But then 30 minutes after that, we have the press conference, and that's when Powell's going to come on. So we definitely want to watch that also because that's normally when the market will actually decide on a direction. The speech usually lasts about 45 minutes to an hour, and usually the question and answer, the Q&A, is normally when the market is potentially going to decide on a major direction. Oh, hey, Jan Barry, how's it going? How's everybody doing today? Yeah, I guess I'm Vini Verde ready to go for when Powell starts. I'm not going to get into it now, but once he starts talking, I'm definitely going to break into it for sure. So, anyways, I mean, I wanted to talk about the dollar for a few minutes because I am a big believer that if you know what the DXY and the US dollar index, I mean, they're almost exactly the same pattern. There's really not a whole lot of difference. There is definitely a little bit of difference because the euro is a big driver in the DXY, and on the US dollar index, it's equally weighted. But if you can come up with a general direction on the US dollar, then potentially you know exactly what to do on the euro dollar, the pound dollar, the Aussie dollar, the Kiwi dollar, the dollar CAD, and the dollar Swiss. Probably not quite so much the dollar yen, and definitely not quite so much on gold. But if you know what the dollar is doing, you literally know exactly what to do on the six main dollar pairs because they definitely follow the dollar index extremely closely. Now, we spent a lot of time, working on this dollar analysis over the last week in the group because obviously we knew this news was coming out. If I was normally I analyze the U.S. dollar index in my videos, but I think that the potential for a WXY is really high, and the DXY is actually the one that to me seems clearer that it is going to end up being a WXY, because first of all we got impulsive down, which I like to change colors here, so stick with me for a second because it really kind of shines the light on it when you start changing colors. So here's impulsive, this is impulsive. And then here's impulsive up. This is impulsive up. And then we have impulsive down. If I switch to the pink, you can see the pink is the 1, 2, 3 way pullback. The pink is the 1, 2, 3 way pullback. And potentially this is going to be, let me do that again. Potentially this is going to be another 1, 2, 3 pullback like this. Now I definitely understand that fundamentally lower interest rates actually should cause the dollar to go down, but I do not think that's what's going to happen. One of the members of the group in my group posted the DXY chart showing the last rate cuts over the last several years, and the last time that they cut rates was actually right here near the bottom. It wasn't the exact bottom, but it was within 1 week of this bottom right here, and then you literally had like a 6-month rally even though they ended up cutting rates. So just because they cut rates and just because that fundamentally definitely does mean that potentially the dollar should go down, I don't really think that's likely what's going to happen here. It definitely could happen. It could just keep on going down, but I think we have a WXY here. We got impulsive, corrective, impulsive, impulsive, corrective, impulsive. We should have impulsive, corrective, and another impulsive in the future. So another impulsive down. And that would be your ABC of W. So you have an ABC of W, ABC of X, and potentially this is going to be an A of Y. This is going to be a B of Y, and then potentially a C of Y. I think I don't really think it's going to just turn into a big giant uptrend today. Um, in my most recent Zoom meeting, we were talking about this, and the last interest rate news event was actually right here. This is the last time that they cut rates. It was back in 2024. And the market didn't just start a brand new uptrend that day. It actually spent about a week and a half just kind of bouncing around, a lot of indecision in the market. But eventually, that rate news definitely did cause about a 6 month uptrend, as you can see. It just took about a week or so before it actually started the uptrend. So we can't really say for sure that today is just going to go up and it's just going to start this big giant uptrend. It potentially could just kind of bounce around a little bit, spend several days kind of indecision in the market and then potentially go up and make a crutch into this whole move down right here. And another thing that it's really hard to not notice, if I go back to the US dollar index right here, to me, it still looks like the trend potentially ended back here. To me, it still looks like a 1, 2, 3, 4, 5 pattern. So I'm wondering if this is going to turn into a WXYXZ pattern because I think that we might already be in the wave B. I think this is potentially the end of the wave A, and then we have three waves of W, three waves of X, three waves of Y. This is going to be three waves of WXYX, so three waves of X, and then potentially another three waves up for the wave WXYXZ. So I think we're potentially going to make, I can't draw very well, we're potentially going to make a Z pattern. I think that makes the most sense. I think we're potentially already in the wave B. I think this is in WXYXZ pattern for the wave B. And most likely it's going to go up quite a bit. So if that's true, then we would want to put our Fibonacci retracement from here to here. And we would want to see if we get a good Fib bounce today, like if this is going to, one of these levels is going to hold or not. Yeah, I'll definitely take some requests. I'm more than happy to look at anything. The news is going to come out in 20 minutes, so right now we are definitely focused on the dollar pairs. After the news comes out, I'll be more than happy to take requests because we're going to have about a half an hour between the news coming out and before Powell starts talking. So I actually I forgot to queue up the speech too, so I definitely got to do that here real quick also. I can do that before it starts, but I gotta get the FOMC speech pulled up. FOMC press conference. Let's see here. There we go, right there. Let me get this pulled up so that way we can have this ready to go also. So here we go. We got the press conference starting about 30 minutes after the news is released. So, anyways, if we think that this is potentially going to go up, then we would have to think that the exact same thing on all these pairs. We pretty much know exactly what to do on every single one of these pairs by analyzing this one thing. This is why I do trade mainly the dollar pairs. I mean, I will trade pretty much anything, but mainly I trade the dollar pairs because if I spend a lot of time trying to figure out what the dollar index is doing, I literally have to do very little analysis on any of these pairs because I literally know exactly what to do on all of those pairs if I know what the dollar itself is actually doing. So it's definitely beneficial to trade the dollar pairs because of that reason alone. So, anyways, looking at the euro dollar on the daily time frame, we're gonna go through all the dollar pairs real quick. We got about 20 minutes. Oh, is it playing? Sorry about that. Let's see here. I didn't even realize. There we go. Thank you for telling me. I have my volume off, so I didn't even realize it was playing. That should be better. Thank you for that. So, if we expect that the dollar could go up overall, then we would have to expect that this could go down. I've been saying this for quite a while now, but I still think that this is one, two, three waves down for three, and I still think this is one, two, three waves up for a second three. I still think this is either going to turn into a 333 pattern, which according to the dollar index, it probably is going to be a 3-3 pattern for a WXY, or it potentially is going to turn down in five waves like this, one, two, three, four, five waves like that. So I still think that's the most likely scenario. If we go down to the 4 hour time frame, I still think there's a very good likelihood that we need to make a wave five. We still look like we're slacking on a wave five. It looks like a wave one, wave two, wave three. I think there's a chance that maybe this is going to spike up, and it could possibly even spike up to the next Fibonacci level. I mean, this is a big news event, so it could literally go all the way up there and then reverse back down, and that would be your wave four, and that would be your wave five, and then hopefully what happens is it breaks starts into the downside, and over the next several days starts a brand new downtrend. So that's definitely my prediction on the yield dollar. Now let's go to the pound dollar. The thing with the euro dollar and the pound dollar is they're extremely correlated, so you would pretty much have the exact same analysis on both of them. One, two, three waves down. Right now, the pound is a little bit weaker than the dollar. That's pretty much the only difference. The pound is a little bit weaker than the euro. I mean, so one, two, three waves down, one, two, three waves up. I think what's potentially going to happen, which I don't think it's over yet, like I said, it could spike up a little, but I think it's either going to make one, two, three waves down for another three-way pattern for a 333, or potentially it's going to make five waves down for a 335 pattern, which is more like a flat. And if it is a flat, then it's probably going to spike up to this 90% right here. It's probably going to go to there because that's where a regular flat normally turns, is at the 90%. A wave B of a regular flat normally turns at the 90% Fibonacci retracement of the wave A. So that's why I think that this is probably going to go up a little bit before it goes down, and especially because of the rate cut. You know, everybody knows that lower interest rates should fundamentally cause the dollar to go down. So kind of the same thing. This is the last end of a correction right here. So we have a one, we have a two, we have a three. Probably got a wave forward. We're probably, I think we're going to spike up to this 90%. I'm definitely not going to try to take the long. I'm just going to let it play out. And if it comes back down and looks like it's breaking structure, that's where I'll probably try to get in. Because like I said, if that's what happens, it potentially is going to start either a five-way pattern down or a three-way pattern down that will likely last several weeks. So that's the pound dollar, exactly the same as the Aussie dollar, exactly the same as the euro dollar. The Aussie dollar to me is a little bit more tricky just because it's not at a Fibonacci level. And the Aussie dollar for a very long time was very, very sideways. But I still think that this whole middle price action right here is like either a wave B or a wave two. So this is either an A or a one, this is either a B or a two, and this is either a wave three or a wave C. Definitely makes the most sense for that. The whole thing is though, is that if it is a wave C, you would expect it to at least hit a Fibonacci level, which we're right in between two Fib levels right now. So that's why I think initially the dollar probably is going to push down a little bit. You know, it probably is going to push these pairs up, but I think it's potentially going to be a spike reversal, what I would call the porcupine pattern. We'll see though. I mean, because like I said this morning, it looks like a one, two, three. So maybe this is an ABC of four, and then it goes up and makes a five, and then it turns down. You know, something along those lines, I think, is going to happen. I think it needs to go up a little more before it actually goes down. Kiwi dollar is pretty much exactly the same thing. That's why I don't make videos for the Kiwi dollar because it's literally exactly the same as the Aussie dollar. It's just usually the Aussie is a little stronger and the Kiwi's a little stronger, so that's the only difference between the patterns. But the Kiwi dollar is actually a little bit clearer to me that this is a five-way pattern, and then this is potentially like an expanding ABC for a wave B or a wave two. This is either a wave one or a wave A, and we're currently either at a wave three or a wave C. If it really is a wave three or a wave C, I mean, I could be wrong about this. I mean, the trend is your friend. I mean, this thing could just keep on going up pretty easily. We definitely cannot rule out the possibility of the dollar just continuing down. Fundamentally, that is definitely what you would expect to happen on a news event like that, like this. U.S. dollar CAD also, the thing with the dollar CAD is it definitely does have a complete five-way pattern. It looks like a complete five-way pattern. So maybe this is going to be three waves up, three waves down. This is going to potentially be a WXY too. It's been several weeks or maybe even several months going up for like another three-way pattern. And this would be the A or 1, which I think it's a 1 because of my monthly time frame analysis. This is a B or a 2. I think it's a 2. And then eventually, probably next year, like next January, we would get another push down for either a 3 or a C. I think it's going to be a 3 personally. The US dollar CAD is actually one of the ones that really, to me, looks like it's missing a wave down. It really looks like the move down is not done. It definitely looks like a 1, 2, 3, 4, 5 pattern for sure. So I think that we are missing a move down. And like I said, we can't rule out the possibility of this thing just going down because fundamentally that is what you would expect. But if it goes down and then comes back to the starting line and then starts to go up and break structure, that's where I'm going to be looking to, start trading to the long side. I would much prefer to see the break of structure because that's kind of the confirmation that you would need to kind of confirm that the whole move down is over. It's not all just about like a Fibonacci bounce. You want to see a Fibonacci bounce and a break of structure. I was talking about this in my Zoom meeting yesterday. I do with my members every week. You can come up with the Elliott wave analysis all you want, but whatever analysis you come up with, you have to allow the market to prove you right or prove you wrong. I think that's the big disadvantage of Elliott wave is once you come up with an analysis, you subconsciously are married to that analysis, and when the market does something to prove you wrong, you subconsciously block that analysis. You subconsciously block what you see on the charts because you're married to your analysis. So definitely be careful. Like you come up with all the analysis you want, but you need to allow the market to prove you right or wrong. If I think this is a wave C, what the market's going to do to prove me right is it's going to go down, then it's going to come up, then it's going to break structure. That's what's going to prove that this is a wave C to me. I could say that this is a wave C all day long, and the market could laugh in my face and just go down and down and down and down, and I could be completely wrong about that. That's why, even though I think this is a wave C, I personally wouldn't go long until I saw it go up and break structure because that would prove my analysis correct. Instead of just assuming that I'm correct, which is what most traders do, I would prefer to allow the market to prove me correct. So US dollar Swiss, and then we'll look at the US dollar yen, and then we'll look at gold, and then hopefully by then the news will be ready to come out. And after the news comes out, we're going to, 5 or 10 minutes after the news comes out, we'll go take some requests for a half an hour until the press conference starts. Grab a drink of water before I switch to my Beanie Verde. All right, so the US dollar Swiss is pretty much exactly the same as the US dollar CAD in many ways. The only thing that's kind of preventing me a little bit from saying, oh, this thing's like ready to go up is we still have not hit this 78% Fibonacci retracement. I've been talking about this 78% Fibonacci retracement for months now. I still think that it needs to hit that. So maybe we are going to get a spike and then back up, something like that. Like I said, I really feel like the dollar initially is going to go down because that is exactly what everybody thinks is going to happen. So it's probably going to go down and trap everybody in a sell and then probably spike back up later on. But if it goes all the way down to that 78%, that's a pretty big move down. I got to get these fibs back on here. Hold on. Put them on my sort. There we go. And, if that goes down to the 78%, that's actually quite a few pips right there. You're talking about 100 pips easily to the downside. I mean, it is the first rate cut of the year, so I mean, there is definitely a chance this thing just spikes down big time and then reverses back up. But yeah, I'll be more than happy to look at other stuff after the news comes out. Right now, we definitely want to focus on the dollar itself, the dollar pairs, like the 6 main pairs or the 7 main pairs, and then gold. US dollar yen. My problem with the US dollar yen, I did actually trade the dollar yen a couple times this week, but I honestly haven't been trading the dollar yen much because I'm a trend trader, and what does a trend trader hate? A trend trader hates sideways markets. I am a trend trader. When the market is sideways, I try to avoid it. Now, I definitely have traded it a few times these last few days, but overall, I definitely avoid a sideways market. I try to trade trending markets, markets that are making lower lows, lower highs, or higher highs, higher lows. I still think that this is potentially the end of a WXY, which kind of goes against my analysis on the other pairs, to be honest with you. Actually, that kind of reminds me, I'm still in a yen pair, which isn't really doing much. It's a pretty small trade, so I'm just gonna let it go. Whatever happens, happens. I'm in the pound yen. I think it's the pound yen, right? Yeah, I'm in the pound yen. Which reminds me, I should probably log into my funded account just in case I do have to do any adjustments. So it's ready to go. All right. If anybody is ever interested in any funded accounts, definitely check out the link in the description of my video. There's an affiliate link there. I think FPMO, not FTMO, but the FXFY is a really good funded program, especially for people in America. I'm from America. I don't live in America, but it's very difficult if you're an American to find a good prop firm. There's really only a handful of prop firms that actually deal with Americans nowadays. And definitely check out my affiliate link for that if you're interested. Definitely a good account to have. But anyways, I need I could say that this is a WXY all day long. That doesn't mean that it's correct. What's going to prove me correct is a nice break and hold below this structure, which it still has not done. Like I said, I could say this is a WXY all I want. That doesn't mean it's true. I think it's a WXY, but what's going to allow me to prove myself right is seeing it break and hold below structure. And then I'm going to be confident that it's a WXY, and I'm going to be confident that it's going to go down and take out the previous lows. And if I go down to the 4 hour time frame, I think there's a WXY inside this correction right here. I still think that it's very clear that this is one, two, three waves up. This is one, two, three waves down. This is one, two, three waves up. Yeah, I still think there's a chance because if you go to the weekly, it makes sense for this to be a wave one, this to be a wave two. It's just stretched out because I think this is going to end up being tuned to the weekly time frame. I think this is going to be a trend on the weekly time frame, which is why it's so spread out on these sort of time frames. If you go up to the weekly time frame, it makes perfect sense for this to be a one, two, three, four, five. It would be a perfect trend if it did that on the weekly time frame. You go down to the 4 hour time frame, it's all stretched out because, like I said, that this has it's trending on the weekly. It's not trending on the 4 hour. So I'm kind of hoping that we get a break of structure. That would be awful nice if that's what happened because that's going to confirm my WXY analysis. But honestly, like I've been saying in my videos, I can't draw a straight line, but what I've been saying in my videos, trading the highs and lows of this channel ever since the beginning of August has been probably the best strategy. So honestly, I wouldn't be surprised whatsoever if this thing just went up here again and went down again and just stayed within the channel. Some people love to trade these tight little channels. They just trade the highs and the lows, try to take, 50 to 75% of the move of the channel, just play it safe. Like I said, I'm a trend trader and I prefer trend trades, so I try to avoid these things. Gold has been pushing up again today. I'm kind of wondering if we're in the wave five. It looks like this is a one, this is a two, this is a three, this is a four, and maybe we're in the wave five right now. What do we got from time? We got just over 5 minutes, so we got enough time to look at gold. Now, every single one of my videos I make for gold, especially lately, I'm just trying to emphasize how important it is to realize these higher time frame trends. The trend is definitely in a wave three on the monthly up. The trend is definitely a wave three on the weekly up. The trend is definitely up on the daily. The trend is definitely up on the 4 hour. The trend is definitely up on the 1 hour. Why would I see an uptrend on the monthly, the weekly, the daily, the 4 hour, and the 1 hour, and then go down to these sort of time frames and look for shorts? I know that some people make really good money counter trend trading, but to me it just seems ridiculous to even think about going to a pair that is in an uptrend on the monthly, the weekly, the daily, the 4 hour, and the 1 hour. Every single time frame is in an uptrend, and then going down here and looking for reasons to go short. To me, it just sounds so crazy, and it honestly kind of reminds me why 90+% of retail traders don't make money, because I guarantee people have been trying to sort the living shit out of this thing the whole time it's been going up. Even though gold has been making such beautiful pullbacks, one, two, three waves down, one, two, three waves down, one, two, three waves down. Almost every single one of these pullbacks is a three-wave pullback. It's unbelievable how nice they are. One, two, three waves down. One, two, three waves down. One, two, three waves down. If the trend was your friend and you spent the last several weeks doing nothing but looking for longs on gold at the end of every single three-way pullback, you would have been pretty damn profitable and probably pretty damn happy over that. So if this is a wave five, right? So we're in a wave three. We are definitely in a wave three. This is probably a wave one. This is probably a wave two. If this is someplace down here, there's a 1, 2, like right there, and then this is a 3, and this is a 4, and now we're in a 1, 2, 3, 4, 5 of 5. It could go up, make like a double top, then go down and start giving you some breaks of structure. If you start seeing some breaks of structure, then okay, fine, start looking for shorts. Just keep in mind what should come next. It's not going to be a complete trend reversal next. What's going to come next is it could go down, break structure, and then spend several weeks in a very overlapping, very, very corrective, complex pattern for wave four, and then back up again for wave five. Because I think there's a very good likelihood that even if this does turn down, it is almost definitely just a wave four, which a wave four should be a correction to the wave three itself. You know, it could make a 38% pullback, it could make a 50% pullback, but very, very, very likely the next move is not going to be a trend reversal. The next move could be a big impulsive move, break structure, and then spend several weeks in an overlapping sideways pattern. This wave two lasted roughly 12 calendar days. So I would expect this wave four to probably last about 12 calendar days also. You know, it could easily last 2 weeks. The first move down could be very impulsive because it could be caused by the news, but more than likely it's going to do something like what happened over here and make a very overlapping corrective pattern for several weeks. Yeah, exactly. Well, I guarantee that Powell is definitely going to talk about being worried about the economy for sure. I believe that there's one more rate decision this year also. I don't think this is the last one. I think there's also one either late November or early December. I'm pretty sure that they do it 6 times a year. Or is it 4 times a year? I don't know. But I'm pretty sure that we got at least one more coming this year. So that's probably the more important part. I completely agree with Yenberry. Probably the more important thing today could be what Powell says about maybe future rates. If it was up to Trump, then they would probably cut 50% today, and they would probably do even more. But they would probably cut it even more next time. But unfortunately, it's not really up to him. So we have less than 1 minute until the news. I just went through all the dollar pairs, including the dollar index. After the news comes out, yeah, he would cut it down to like 2% tomorrow. And I think the whole reason why Trump is so hot and horny to get rates lowered is because of his own pocket. Trump is a big owner of real estate. He owns a ton of real estate. And he even said it this week that if interest rates go down, then the real estate market is going to skyrocket. And what's going to happen to Trump if the real estate market skyrockets? He's going to be friggin' rolling in the dough, and his family's going to be rolling in the dough. So that probably has a lot to do with his decision, to be honest with you. He's a huge owner of real estate. All you gotta do is go to Las Vegas and you'll see the building. Here we go. 1 second. Oh, I gotta see what's going on with my trade too. Ooh, come on, pound yen, down, down, down. Trying to go down. Okay, so this is likely a wave five. Ooh, I gotta switch my charts over so I can watch this one. Yeah, there we go. Oh, it spiked down. Now it's probably gonna go back up, isn't it? What was the news? Did they cut it? 25 points? 50 points? What was it? 25 points. So, as expected, it was not a surprise to the market, and that is a very important concept. This news event was not a surprise to anybody. Pretty much everybody knew what was going to happen. Ooh, I'm hoping that this drives the yen pairs down for me. I'm short the pound yen. I went short a couple hours ago. Ooh, here we go. Starting to move into some profit now. Ah, no, my funded account, my personal account is fine, but my funded account spiked me out. That's stupid. Oh well, stuff happens. Anyways, that's okay. My personal account, I'm still short, so whatever. So anyways, I think there's a very good likelihood that this is a wave 5. What's going to prove that to me is if it goes down, it gives me a break of structure. Nice break of structure is what's going to prove to me that this is a wave 5. Definitely not a big giant mover. Ooh, pound yen's doing pretty good. I would prefer to see money on my personal account anyways, but yeah, it kind of sucks at the funded account. Must have got really widespread at the news. Normally I don't even trade normally I don't even trade the news, especially on the funded account. All right, pound dollar's pushing up. Oh, Aussie dollar's pushing up. I mean, this is literally going exactly as we expected, so everything's doing pretty good so far. I gotta move this down here so that I can potentially see what's going on. There we go. I'm trying to watch my trades and do this all at the same time and look at the chat, so let's see. There's probably a pretty good chance that that this is gonna come all the way back to the starting line, but we'll see. All kinds of stuff coming out. What happened to gold? Did it go up? Oh wow, gold just spiked all over the freaking place. Holy mackerel. Gold just stopped everybody out. One of the reasons I'm not a big fan of gold is I think that most people that trade gold are either like really long-term investors, like they're trading like the, buy and hold strategy, or they're trading like the 1 minute time frame. And because of that, I think that gold has more scalpers than in pretty much any other pair. And I think because of that, gold likes to do a lot of stop hunts to stop out all the scalpers. Hey, menu, there's the gold man right there. Oh, US dollar yen is trying to break structure. Man, if that holds below structure, that's going to kind of confirm direction for me for a while, probably. Nice, 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 nice. Finally, nice to see a breakout on the dollar yen. Finally. Hopefully it holds. Now, like I said, this looks like a wave 5. It looks like a 1, 2, 3, 4, 5, but it doesn't have to be, which is what I said in my videos today. I mean, there's really nothing stopping this from going up. If you've watched my full top-down videos, you know that my main analysis on the euro dollar is 1.34. That's been my main analysis for pretty much a year now. Is that the euro dollar is going to go all the way up to 1.34 potentially, and this is going to end up doing something like this. I honestly was kind of hoping that I was incorrect about that. I was kind of hoping there was an ABC correction to this last wave down right here, and I was hoping that it was going to potentially turn down like that. But my main analysis, you can watch my euro dollar videos from almost a year ago. I've had the same analysis on the euro dollar on those high time frames. Yeah, definitely. Best to let things settle down a little bit. Yen pair's kind of spiked up and spiked down too. Let me switch over and see what the yen basket's doing. I was kind of hoping that we were gonna confirm the end of a wave B today on the yen. So now that the news is over, we got about 25 minutes until Powell starts talking. So I can definitely look at some other things. I was kind of hoping that the pound yen was gonna go down for a wave C, and then potentially go up for to finish off this wave Y. Something like this. We are definitely getting close to a big turn on this pair, but when you're talking about the daily time frame, a big turn could be anywhere from, you know, a couple of days to, a month or more when you're talking about the daily time frame. Yeah, yen kind of spiked around a little bit. Ooh, Aussie yen looks like it wants to go up. Aussie gets affected by this news usually too. Aussie and the Kiwi. Anything that's risk on, risk off, like the yen, the Aussie, the Kiwi, and the Swiss, normally get affected by these dollar news events pretty heavily. The Swiss pair's moving. A little bit, not much. I bet the Aussie pairs are moving, aren't they? Let's check out the Aussie pairs. And the Kiwi pairs. Ooh, Aussie dollar's posted up. Aussie CAD's posted up. Menu was looking at this one earlier. Aussie Swiss is posted up. I haven't been keeping up with many of these other pairs lately, but I try to keep up on the higher time. Ooh, wow. I think that we still need another wave down on this Euro Aussie. I wonder if that's a motor wave correction. The market definitely likes the Aussie pairs definitely like to make motor wave corrections. I kind of feel like this thing still needs another wave down. It doesn't look like it's over yet on the higher time phase. I wonder if it's just going to go down from here. Kind of seems like it should go down to like the 78% in my opinion, at least. But it could end up being like a running pattern, which means it would be a higher low. But yeah, that definitely looks like if it goes down and breaks struts, it potentially could turn into a little bit of a swing trade, even though it looks like a trend. It definitely looks like a trend, but the Aussie pairs and the Kiwi pairs do like to make motor wave corrections for sure. Oh wow, yeah. This pound Aussie definitely looks more like a correction. That possibly could be the end of a pullback on the pound Aussie and the Euro Aussie. But the Kiwi pairs, I normally don't trade the Kiwi pairs because the spread can get pretty wild, but Kiwi pairs too. Oh wow, Kiwi's pushing up pretty hard too. Pretty much the same pattern on the Kiwi, the Yo Kiwi. Oh man, the Yo Kiwi is actually the one of the ones that makes me think that it could keep going up, but a lot of that is because of the weakness of the Kiwi. This one actually kind of looks like it could go up a little more, but that could just because of the Kiwi, not so much the Yo. Yeah, that one kind of looks like it could push up a little more too, but it kind of looks like one of those patterns that potentially would fail, like it would make a lower high, and then go down. That would be like your ABC or something, and then potentially go up from there. Oh man, the dollar might just keep on going. It definitely could keep going. Yeah, I just looked at the pound yen. I'm actually short the pound yen, but it's not really doing a whole lot. It's went into some pretty good profit, but pulled back pretty fast. I was hoping that the pound yen was going to be the end of a correction on the daily time frame, but I'm not really sure if it really is or not yet. I would hopefully it's going to be a nice engulfing move down by the end of the day. If it is, I'll probably just hold on to my trade for a couple of days, honestly. Even though I have been kind of day trading more than anything lately. I thought it was going to go down and make a wave C before it went back up one more time. It actually could be an ABC here too, so we need to be careful. It could actually just go down, take out these lows, and then go back up. But it seems like it needs to make a wave down. The problem is that the trend is your friend, and the trend is definitely up on most of these time frames. I went short on the pound yen right around here, like 2 hours ago. I'm still short. That was one of the trades that I took today. If anybody is interested in checking out my website, it is extremely cheap. It is only $30 a month, and I do share every single trade I take with the group at the exact time of entry. So it's fxpipcollector.com. Pretty easy to remember if you are familiar with my YouTube channel. All my social media stuff is all FX Pip Collector. So it is only $30 a month. It's a monthly membership. It's very, very cheap. It comes with a trading course that covers a ton of stuff. There's 34 videos in here. It took me about a month and a half, 2 months to make all these videos last year. And then it also comes with a ton of educational information on Discord. And every single trade I take, I share with the group at the time of entry. Normally, I'm more of a swing trader, but to be honest with you, with the Trump administration, day trading has been a little bit easier, to be honest with you, than swing trading, just because the markets are a little wild sometimes. Ah, thanks a lot, buddy. I consider myself a really good Elliott Wave analyst, but my trading psychology definitely gets the best of me sometimes. I'm a way better analyst than I am a trader. I'll be the first person to admit it. I mean, I'm a pretty good trader. I make money, but I am right about my analysis more than I'm profitable on my trades, if that makes sense. But I think that's kind of the thing, That's kind of why I like helping other people because I get a lot of satisfaction about other people making money with my analysis, even if I potentially am not. Thanks a lot, buddy. Yeah, I try to keep things clear and simple. I try not to use a bunch of indicators, even though I do have a CCI indicator that once in a while I will look at. But like it says on my website, I like to try to teach people how to trade without all the useless indicators that everybody uses. Fibonacci, Elliott wave, maybe some channels like what Yenberry does. Channels are definitely really good. Just looking for flats and stuff like that, like when Menu does, that just keep it simple. Use the same tools that people have been using for 30, 40 years, which is Fibonacci and Elliott wave and channel analysis. You don't need all those crappy indicators and oscillators and moving averages and all these things that, they definitely can help, but you're kind of better off without all that stuff, to be honest with you, in my opinion. All right, is the dollar going to actually pull back, or is that just going to keep going? Did it make its way up to that 90% at the 123? Not quite. Ooh, before the news came out, I said that the 90% is the most likely area for a regular flat to turn. So if it does turn, it definitely just hit that, area where I would expect it to turn. Nice. That's good. That's real good. Good news. So if anybody has Um, if anybody has any requests, definitely put them in the chats. I'm more than happy to look at anything for sure. So if you have something you want me to look at, put it in the chats. I'll be more than happy to look. I already looked at the US dollar yen, but I don't really mind looking at stuff more than once. I've been doing these live streams. I try not to look at the same thing too many times because the people that have been here since the beginning, it starts to get a little unfair if I just keep looking at the same thing. For sure. So, anyways, yeah, let me look at XPR. We kind of looked at the pound Kiwi, pound Aussie briefly. I can look at them again. Let me look at the. I'll look at crypto for you. I'm not a crypto trader. I've never traded crypto in my life. I do own a tiny, tiny, tiny bit of Bitcoin, but not very much. That's for sure. What's going on with the yen trade? Oh, it's still going. It's still good. So anything that I don't analyze on a regular basis, you have to kind of take it into consideration that it's just an educated guess. But I remember this from the last time I looked at it, which is to me, it looks like it needs to make another wave up. I think we need to make a wave 5. I think we're going to have to go up and retest these highs right here. So I'm pretty confident that it's going to go up again. And it kind of looks to me like it's already on its way up, honestly. I mean, it looks like a potential ABC already, honestly. I would definitely be bullish on this. I would definitely be looking for longs on pullbacks for sure. This is a pretty impulsive move down, so I wouldn't really want to try to go long right this minute, but I definitely would be looking for longs on pullbacks. I would want to try to find a three-way pullback to go long on. So let's see here. Anyways, let me just do this real quick. I just want to send my live stream link. Somebody was asking what the link was. Give me 1 second. So yeah, anyways, I think that we need to go down one more time for a wave C. I would expect at least a 61% pullback, maybe a 78% pullback. But depending on what kind of trader you are, I mean, if you're more of a swing trader or something like that, then yeah, you could definitely just be patiently waiting for a long. If you're more of a short time frame trader, you might be able to get a couple of shorts out of this over the next couple of days, down to the 61 to the 78% for sure. But I would keep an eye on these levels. I mean, if it gets to one of those levels and then turns back up, then it is very likely going to be the end of a pullback and the continuation of the uptrend. So definitely keep an eye out for that for sure. So, anyways, yeah, let me take some requests. I'm gonna look at the dollar pairs more, especially when Powell starts talking. So I'll probably wait a little bit on that. I'll check out the pound Aussie, pound Kiwi. We kind of looked at them a little bit, but only briefly. I pretty much only have been analyzing these on the higher time frames because I mostly have been trading the dollar pairs lately. I still have a feeling that all these pairs need to go down a little bit more. I'm not really convinced that the move down is finished yet. I think it's potentially more likely that it's going to go down to this like the 78% or something like that. Yeah, we'll definitely look at gold for sure. So I'm not really too confident that this is over yet. I think that it need, maybe it's going to go up actually, right? Because this is one, two, three waves down. So one, two, three waves down. A, one, two, three waves up. B, maybe this is in a WXY. Actually, that does make a lot of sense if it would be a WXY. Hey, Skywick, how's it going, buddy? Nice to see you. Yeah, I'll definitely look at the dollar pairs again. We got Powell coming out in about 12 minutes, and I'll definitely be looking at the dollar pairs more then. The pound Kiwi is actually quite a bit different than the pound Aussie, and normally they're very, very similar. But lately, uh, but lately the Kiwi has been a very weak currency, which has caused the pound Kiwi to be quite a bit stronger. Um, if you trade any of the Aussie or the Kiwi pairs, whether you want to trade the Aussie Kiwi or just use it as analysis, I would definitely use the Aussie Kiwi. If you trade the pound Aussie or the pound Kiwi, I would use the Aussie Kiwi to help tell you which one you should potentially be trading to the long side and what's one you potentially should be trading to the short side. Right now, obviously the Aussie is way stronger than the Kiwi. So if you're looking to go short, then you want to probably go short the pound Aussie or the Euro Aussie. If you're looking to go long, you probably want to go long the Euro Kiwi or the pound Kiwi. Yeah, definitely. I bet Yenberry does that with his trading, definitely. So you may not be actually trading this pair, but you may be using that pair to help you trade the other pairs. Kind of the same thing with the Euro Pound. You know, many people don't like the Euro Pound, which I agree. The Euro Pound is not really a great pair sometimes. But if you're trying to decide whether you should trade the Euro, like the Euro dollar, or maybe the pound dollar, then the Euro Pound is a really good pair to analyze. You know, if you could figure out whether the euro is going to continue to be stronger than the pound, then obviously you would want to trade the euro to the long side, and you'd want to trade the pound to the short side, like the pound dollar to the short side and the euro dollar to the long side. It's a big help, and like I said, you may not be trading this pair at all. You just might be using it to help you trade the other pairs. I don't. It kind of looks like it needs a wave five, but because of the shape right here, I think that it's probably not that. I bet it's gonna make a lower high, lower high. Maybe it's just up a little bit, but I think it needs to go down a little bit. I think they both need to go down a little bit more. Something along those lines. Honestly, the Aussie Kiwi does kind of look like it needs to go down a little bit for like uh, a wave four. So maybe the Aussie's gonna lose a little bit of strength for a few weeks, and the Kiwi is gonna gain a little bit of strength for a few weeks and do something like that. Definitely seems like it would make the most sense for sure. So, anyways, yeah, let's see here. What do we got for requests? I'm gonna look at dollar pairs again. Let me just scroll through the chats a little bit, see if there's some requests besides the dollar pairs I can look at before we switch back to the dollar pairs. I'll be more than happy to look at the dollar pairs for sure. Oil for Sergi. Yeah, let me look at oil real quick. WTI, which is another pair I honestly haven't looked at in a while. I mostly am only trading the dollar pairs, so I'm not really trading a lot of these other pairs anymore. I really think I think that gas prices are going to go through the roof over the next year or so. That's my prediction. I think this is very clear. The part that's not clear is whether the correction is over. It doesn't really look like it's over. But I still think this is an A. I still think this is an A of B. I think this is a B of B. I think it needs to go up and make a wave C of wave B. I think this potentially could be a wave one, a wave two, and eventually it's going to turn up and make a wave three, a wave four, and a wave five. So I still think that oil is going to be very expensive over the next year or so. You know, gas prices. I think that it potentially is going to go up to about $100 a barrel at some point. So Definitely still very bullish on this for sure. Like I said, the part that's not really clear is whether the correction is already over or not. It's not really clear to me at all whether the correction is over. We definitely have what I would consider a complete three-way pattern. We have, impulsive down. We definitely have three waves up. We definitely have an impulsive downtrend. We definitely have a break of structure. So we have the completion of a three-way pattern, but it definitely did not bounce from a Fibonacci level, which is a little concerning, which makes me wonder if it's actually going to turn into more of a complex pattern like an ABCDE or like some kind of a flat or WXY or something like that. It kind of seems to me like it needs to go down to the 78%, which is right around the $60.50 area. $60.50 is what it seems like it should do to me. Uh, yeah, I mean, there's definitely no reason to think the dollar is going down yet. Powell could definitely change that though when he starts talking. There's no doubt about that. So definitely, yeah, oil can be kind of tricky. It's natural gas. I thought natural gas was ending a correction too. It's another pair that I don't trade, but because you can't really trade everything. If you're a real swing trader, like trading like the daily or the 4 hour time frame, you could trade, 30 some odd pairs, but you would have to be a real swing trader to trade that many pairs. Like not even when I used to work a full-time job, none of these sort of time frames existed to me. Nothing below the 4 hour time frame was even on my chart. When I worked a full-time job, it was the 4 hour time frame and up. None of the sort of time frames even existed to me. I never looked at them ever. And that's really the only way to be a successful swing trader. You cannot be a successful swing trader and expect that you're going to be looking at the sort of time frames and stuff like that. I think natural gas might be going up overall, though. I mean, I would definitely be looking for pullbacks on that thing for sure. Oh boy, we're coming back to the starting line already. What a classic FOMC this is, honestly. Probably right around when Powell starts talking, it's probably going to be all the way back to the starting line. And then hopefully it goes down and breaks structure. If it does that, I think we have a very clear pattern on our hands. Yeah, I've been trading week. I've been trading like the 15-minute time frame, but that is about as low as I'm willing to go because I've been kind of day trading a little bit more. But 15-minute time frame is kind of lower than I normally prefer to go. But for me, who provides trades for other people, I mean, most people want to either be a scalper or a day trader. Most people don't really want to be a swing trader because they don't believe that swing trading can make money, even though it definitely can. I turned, I made almost $100,000 over the course of a couple of years with doing nothing but trading the 4 hour time frame and up. But it took me a few years to do it. But I turned that $1,200 account into almost $100,000 over the course of about 3 years. But it's slow and steady. It's not like you're taking trades every single day. You're only taking a couple trades a week. Maybe 3 trades a week tops. Most people don't want to take 3 trades a week. They want to take 3 trades an hour. They want to be just in and out constantly in and out of trades. So, like I said, if anybody hasn't done so already, definitely check out my website. It is fxpipcollector.com. We got Powell starting his speech in about 6 minutes. So, if anybody wants to request something before the Powell speech starts, which is 2:30 Eastern Standard Time, 2:30 DC time is when the speech starts. So that is we'll be starting soon, and I definitely want to hear what Powell has to say. So I'm not going to be talking through most of it because I definitely want to hear what he has to say. Honestly, probably what I'm going to do is I'm going to start the speech. I'm going to go open my Vini Verde, and then I'm going to sit here and watch the speech. Oh boy, gold. I do think that gold could turn. It definitely looks like it could turn. It really does. It looks like 5 waves of 5 right now. I think this is a 1-2. This is a 3. This is a 4. I think gold is going to turn. I think it's going to go down and break this structure. I think there's a good chance we're going to get a pretty good push down for a break of structure. So, anyways, yeah, definitely keep an eye on that. I mean, if you try to go short now, you're kind of assuming something where there's really no proof yet. But I mean, to me, it definitely looks like there's a good chance it's going to go down and take out this low, especially now. Look at that. One, two, three, four, five. Now we need to see a break of structure. That's going to confirm the end of that whole move up, most likely. Yeah, let me look at the Aussie dollar for Skywick. He's been in almost every single one of my live streams for geez, probably the past like 2 years. I feel like he's in my live stream. So definitely appreciate the support, Skywick. You've been a great supporter. If anybody hasn't done so yet, definitely like and subscribe to my YouTube channel. I try to do these live streams every single Wednesday because it's a really good way to interact with my hardcore followers like Skywick. He's pretty much always around. So definitely do so. I used to have a free Discord channel, but unfortunately the scammers ruined it for everybody. So I still have a Discord channel, but unfortunately it's only for paid members now. There's still a lot of people in the free channel, but it's only the people that I know 100% are not scammers. So the free channel is not available anymore. The only way you can get access to my Discord channel is through my website now. You have to sign up for my website, which is $30 a month. And that gets you access to all these channels, including all my educational information, which basically every single Elliott Wave pattern that exists is in here. I do Zoom meetings twice a week. I have this alerts channel, which honestly, not many people take advantage of this, but this is literally how almost all my trades are based on this alert channel. And it is only $10 a month for that. So definitely check that out also. And every single trade I take is said with my group at the exact time of entry. I went short the US dollar Swiss today. It was just a little trade. I only took 4.4 pips, but I also went short the pound yen. It tells you my entry price. It tells you my stop loss. If I use a take profit, it tells me that. It tells you when I move my stop loss to break even. Yesterday, you can see that I took 3 trades yesterday. I went long the pound yen yesterday for 15 pips. I went long the euro again yesterday for 28 pips, and I went short the US dollar yen yesterday for 31 pips. So I made a total of 75 pips yesterday. Now pips don't really mean anything because you could trade a pip could be 10 cents. So 75 pips if it's 10 cents a pip is like nothing, but a pip can be anywhere from 10 cents to thousands of dollars per pip. So a pip could be very little money or it could be a ton of money. So but you can see I also do weekly reports. I do monthly reports. Last month I made 627 pips in the month of August. So I do monthly reports, weekly reports, and everything else. So if anybody is interested, definitely check it out. It's extremely cheap. I am not looking to get rich off my memberships. I'm looking to get rich off my trading and compounding my trading account over time. That's why I only charge $30 a month for my membership. So, anyways, we got Powell starting in a minute here. Should be pretty interesting to see what he's got to say today. Ooh, I paused it, so let me fast forward. I'm interested to see what the guy has to say because Trump is putting a lot of pressure on this rate cut. And I'm pretty sure we got one more rate decision this year. Oh, you keep trying to go short on gold? I was just talking about earlier today how anybody that has been a trend trader is probably making a killing on gold. Trend traders have been killing it on gold lately. Okay, here we go. We got Powell starting his speech here in a minute. Let me move this little thing out of the way. I'm going to turn the volume down until he comes out. I also want to do like a split screen thing, so let me do that real quick. Probably better off with the vertical split screen like that. We can make this one a little smaller so that way we can see more chart. Here he comes. So I want to hear what Powell has to say, so I'm not going to start talking again until this is over.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by a quarter percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. A Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just a quick follow-up. Can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible and that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timoroso, the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. But what we can say is this: that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks, which the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that, but we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to to the much lower level of job creation and other evidence of softening in the labor market, and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now, and so that warrants a change in policy.
Colby Smith for the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening, or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off, and that tells you that it's time to take that into account in our policy.
The SEP, once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low, it's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So that's what I meant by that.
Like a follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028 at the end of 28, but that's, that's literally how you put the projections together. You're writing down a rate path, which is designed to create over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years, but the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that the effect, basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that though, right? We have to. Our job is literally to make sure that that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass through of the tariffs into inflation has been slower and smaller. The labor market has softened, so the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal. So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of a more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on, so that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is, it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. and as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low, and when the labor market is really strong, that's when you gotta be careful about inflation. So we have a situation where we have two-sided risk, and that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based on, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and they're making their arguments, and we're having really a great discussion around these challenging issues. So,
see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do Of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that. And it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still well good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
For the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action. And we took that appropriate action today.
Thanks, Howard Schneider with Reuters. So, as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. The black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And markets has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that, you see minorities, unemployment going up, you see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all this together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
Of course, I'm not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Bank system, Federal Reserve system, and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
Not an independent review?
We're certainly open to to always trying to do better.
Yeah.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college, and yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down, and so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing. Was that goods inflation was goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic. Of course, goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, analysts have different views, but we think it's contributing, 0.3 or 0.4 or something like that to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it to retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. we've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of his speeches, for example, and then some of the forecasts that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really. The only way for any voter to really move things around is to be incredibly persuasive, and the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters, and that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you heard about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times, but from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, those are our two equal goals. and you will see that there are a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Thank you, Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly, and that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up outside, just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
If I may, you mentioned that downside risk to employment is a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PC numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in. It's a good bit from consumption. It looks like consumption was stronger than expected. What we got earlier this week, I guess. And also we're getting a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So we watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, builders will help supply. And so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot, for the big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up, during the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
You know, forecasting is very difficult even in placid times, and as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. You know, the level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession. And delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances? And do you expect today's cut will help?
So, we're aware of that. I think default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have a visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
This rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. we don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities. And I would say those are not elevated right now.
Jean, what are you for the last question?
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter term inflation expectations have tended to respond to near term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer term inflation expectations both break even in the markets, and almost all of the longer term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. But we're, as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. I don't. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates. Thanks very much.
All right, it's over. As usual, he said a whole lot of stuff, but didn't really say anything too clear. Powell is like the master of talking. He's really good at answering questions without actually answering the question. So yeah, the FOMC interest rate, 25 basis points. By the sound of it, there definitely is a chance that maybe there'll be another rate cut this year. I thought there was only one more rate decision, but I thought I heard him say that there was two more. So, it's only September. What is it, every 6 weeks or so? So we got 1, 2, 3, that's 3 weeks. 4, 5, 6. That puts us to probably the end of October. There might be another one. And then probably the middle of December, maybe before the holidays. So maybe there is two more rate decisions this year. I kind of doubt they're going to cut two more times, but I mean, it definitely could. So anyways, yeah, let's look at the dollar pairs, man. As usual, there was a big old liquidity grab and literally pretty much exactly back to where we started. Before the news came out, this is literally pretty much exactly where we were. So it's pretty common for this news to do that. At the beginning of my live stream today, I briefly showed that the last time they cut rates was actually over here, was right here. So the last time that they actually cut rates, which I didn't even do this research myself, this was a member of my group, but the last time they cut rates was actually over in this area. So, it went up, it went down, it kind of bounced around for about a week or so before it actually started trending. But the last time they cut rates, it actually turned into a big uptrend that lasted many, many months. So I don't know for sure that that's what's going to happen, but I do think that there's a very good likelihood that the dollar needs to make a move up. I personally think that this is potentially now going to make three waves up, maybe even take out these highs, but it doesn't necessarily have to do it today. It potentially could bounce around for up to a week before it actually starts to move up. And I still think this is going to be an A, a B, and then eventually down to a C. So I don't really think that the downtrend is over on the dollar. I still think that it is going to go down more, but I still think it needs to go up to like the 50 or the 38%, and then probably down again. And that's going to complete this WXY pattern. And this is a really high time frame outlook, but maybe 1 or 2 years from now, this actually could start a brand new uptrend because it's still, to me, I still think that this is all just one big correction to this last impulsive move up. So I still think that the dollar is going to rally a lot, but probably not next year. It's probably like 2027 or something, 2028, kind of a long outlook. But those higher time frame outlooks are pretty important, especially if you are trying to be some sort of a swing trader. So looking at the euro dollar, I'm going to make my PM video, so I'm going to keep this pretty brief. But looking at the euro dollar, like I was saying earlier today, I still think this looks like three waves down. I still think this looks like three waves up. It missed the 123 by a little bit, but an A and a B, the 123.6 is a good target for a wave B. So I still think there's a very good likelihood this is now going to go down and make a wave C, either 5 waves down for like a flat, which it looks like a flat, so it's probably more likely going to be 5 waves down, or perhaps it's a WXY because you can have like expanding WXYs, which would be 3 waves down. So that's still my outlook on the euro dollar. Pound dollar is the exact same thing. I still think this looks like 3 waves down for an A. I still think this looks like 3 waves up for a B. So it's a 3-3 pattern, 3 waves down, 3 waves up. 90%. Before my live stream even started, before the news even came out today, I said there's a good chance this is going to go up to the 90%. And why? Because the 90% is a target for a wave B of a regular flat. If you have a lot of knowledge about Elliott Wave, you can come up with a lot of really, really accurate forecasts. Yeah, no problem, buddy. So more than likely, if this is a wave A, B, and this is a regular flat, then more than likely this is now going to turn into 5 waves down because a flat is supposed to be a 3-3-5 pattern. So if that's the case, this should turn down and take out these lows, maybe even go for these lows over here. Aussie dollar is definitely a little bit different in my eyes, but it did go right up to the 138, which is also a good target for a potential wave B. So maybe this is, maybe there is like a wave A in here someplace. I kind of gave up trying to count this because for a while I was like, oh, okay, well, this is a W, this is an X, this is a Y, this is an X, this is a Z. But when you start getting into more of these complex corrective patterns, you're kind of just better off not even trying to count them because when the smoke clears, you can probably put a correct label on it. Trying to correctly label one of these extremely complex A, B, C, D, X, Y, A, B, C, D, E, F, G type things, W, X, Y, X, Z, or whatever it may be, very, very, very difficult. So maybe they really, if just because of correlated pairs, looking at the euro and looking at the pound, maybe this is actually a wave B. Maybe this is like a wave A, and this is like an A, and this is a B, and this is a C of B, and maybe it's going to turn down, take out the lows, and then go back up. Definitely, definitely. Yeah, definitely a newly discovered artist. I love to draw pictures because I've never really been much of a fundamentalist, so the news kind of bores me a little bit. So if I draw some horns and draw him smoking a blunt and stuff like that, it kind of keeps me occupied a little bit. I always base all my trades off the patterns, off the charts. I honestly don't pay really hardly any attention to the news. I obviously want to know when the news is coming out because these news events definitely do cause turns in the market. But as far as these numbers are concerned, for the most part, I don't really give a crap because lower interest rates should cause the dollar to go down. Is the dollar really going to go down? I don't think so. I think the dollar is going to go up, which is completely the opposite of what the fundamentals potentially would say. So US dollar CAD, I mean, it definitely looks like it formed 3 waves down, doesn't it? I mean, it looks like a potential ABC pattern, doesn't it? If it's an ABC pattern, then it's probably either going to make 5 waves up or possibly 3 waves up and maybe even take out the high wave 4, which would line up with the dollar. The US dollar Swiss to me is still looks like it needs to go down, which is why I'm like, okay, maybe it is going to go up for a couple weeks, but I still think it needs to make another wave down. Definitely, definitely, I'm not convinced that that is over. US dollar yen rejected structure. Oh my god, I'm kind of sick of the US dollar yen. I have traded it a couple times over the past couple weeks, but like I said, I'm a trend trader, so I really prefer not to trade sideways markets. I mean, who knows? This thing could literally go right back up to the top of this channel for all I know. I mean, it could go back up here, it could go down here, it could go back up here. I mean, we are definitely still within this channel. I was hoping for a break of structure, like a break and hold below structure, not a rejection of structure. A break and hold below structure to me would have confirmed the end of a correction, end of a pullback on the weekly. Definitely didn't get that, unfortunately. And I still think gold could be a wave one, wave two, and I think we could be completing a wave three. What's going to prove to me that this is a complete wave three is a break of the wave four of wave three. I can call this the end of a wave three all day long. That doesn't mean that it's correct. The thing that's going to make this analysis correct is seeing a break of structure. You know, like I said, we can analyze the living crap out of these things, but it doesn't mean that it's correct. You can analyze it, come up with a forecast, but you need to allow the market to prove you correct or prove you incorrect. What's going to prove us correct is a break of structure, and we definitely don't have that yet. And what does that mean? There's definitely a chance this could make a higher low. There's a chance it could go up again. I personally think that it is going to go down and break structure. I think that it is going to go down and break this low right here and start a wave four. I think it's going to go do this and then probably something like this and then go up one more time is what I think is going to happen. I think we're going to be in a pretty sideways market for quite a while, especially after such a strong wave three trend. But like I said, I can call this a wave four all day long. It doesn't make it correct, that's for sure. I mean, 1 hour time frame, I would have my Fibonacci retracement on there. We have 1, 2, 3, 4, 5 waves up. The only thing I know 100% for sure is that these 5 waves are over. It could potentially bounce off a fib level and keep going up. I think that it's going to go down and take out this low. I think it's going to go down to 36.15, maybe 3600, maybe 3605 or 3600. But what I think and what could happen is two different things. That's why I try to really emphasize to my members in my group that you can come up with the Elliott wave analysis all you want, but you need to allow the market to either prove you correct or prove you wrong. You cannot get married to your analysis. The only thing I know 100% for sure right now on gold is that this last 5 waves is over. There's only two things that can happen right now on gold. It either can make a correction to the last 5 waves, bounce from a fib level, and continue the uptrend. Option number one. Option number two is it makes lower lows, lower highs on maybe the 15-minute time frame, goes down, gives us a break of structure, which would be a wave A of wave four. So right now, I mean, I would probably be recommending shorts on gold, but I would definitely probably on like the 15-minute time frame, if it makes like a double bottom at a fib level or something, break structure up, I would definitely stop looking for longs. I would definitely go back to looking for longs 100%. So anyways, I'm going to make my PM videos. I make a video for the euro dollar, the US dollar yen, and the gold every evening, or at least 4 times a week. So I'm going to do that now. And then tomorrow morning, back to normal business. Now we have a lot of news coming out this week. This isn't the end of the news, that's for sure. We got Aussie news tonight, which for me is at 2:30 in the morning, so definitely not a news event I'll participate in. I live in Europe, so just keep in mind that, you know, right now it's 8:30 at night. Anybody that's living in America, it's probably just afternoon for you. Tomorrow we have interest rate for the UK, which they do not plan on lowering interest rates. Thursday night, which is another news event that I will not be participating in because it's extremely late for me, is the yen news. The JPY also has interest rate this week. So there is still a lot of news this week. There's a ton of news still this week. So it's a very, very busy week in the market. And then next week we got all this PMI news, and next week we got Swiss interest rate news. So very, very busy week in the market, 100%. So anyways, I will thank you for joining my live stream. I try to do these live streams every single Wednesday, so definitely make sure you like and subscribe. Hit that notification bell so you don't miss out. If you haven't done so already, definitely check out my website. My membership is extremely cheap. It's only $30 a month. And I do share every single trade I take with my group at the exact time of entry with stop loss and everything else. Comes with a trading course and a ton of educational information. And like I said, it's extremely cheap, especially for what most people charge for this type of stuff. So definitely check that out if you're interested. If not, liking and subscribing to my YouTube channel is definitely enough support for me. And as always, thank you for watching and happy trading to everyone.